Hello, good evening, everyone. Thanks for joining us on our live webinar on Capitalise on a bearish stock market using CME Index Futures. I'm Phil Gunn. I'm your presenter for today. We'll be starting the session proper in about 2 minutes. Just give a couple of minutes for the rest of them to join us. And meanwhile, just grab a drink or a toilet break and we'll start real soon. Once again, thanks for joining us on our live webinar on Capitalise on a bearish stock market using CME Index Futures. This is Phil Gunn. I'm an account manager with Phillip Futures. In today's webinar, we'll be discussing on how to get started in trading on the CME Index Futures, as well as rolling over positions using the spread market. Before we begin, I would like to do a sound check. If you can hear me loud and clear, just type yes into the question box. Oh yes, during the webinar, if you have any questions, do type them out into the question box, and I'll address them during the Q&A session at the end of the webinar. All right, seems that is good. So welcome everybody. This is the webinar on Capitalize on the bearish stock market using CME Index Futures. As a result of the pandemic, there has been a change in our consumption pattern. People are starting to order more stuff online rather than consuming services at restaurants, cinemas. This sort of started the supply chain disruptions as other factors such as the workers' shipping got affected. The situation feeds on itself. Now there could be a continuous goods supply chain disruptions into 2022. Now this could mean companies not able to produce the goods in time due to delays, and this will affect the earnings of companies. This in turn could mean a potential correction in the stock market, especially when the Federal Reserve is going to taper the QE coming the next FOMC meeting. In the event when the correction of the stock market happens, you can get on board of this downtrend by using the CME Index Futures for the short trade, meaning that to sell the direction down. Well, before we begin, let's just do a self-introduction. I'm Phil Gunn, the speaker for the webinar. I've always had a strong attraction for trading, and it started when I was studying in university for my degree in computer science. This made me decided to join the industry, so I have more tools and access for acquiring the knowledge in trading. So it has been 13 years since, and I've learned a lot in this long journey. So I hold a dual license in futures and stocks, and I'm an account manager to help clients trade in futures and forex, as well as shares, with understanding the product and market by providing coaching and economic information to make proper trading decisions. So investors are always looking for opportunities in the market, and I'm excited today to share on the CME Index Futures, once again, that is now offered for retail clients. There is the micro size, which is a smaller size, and the regular E-mini size. So the entry level is catered to most retailers, especially in the sense of risk management, which is important when trading futures. For beginners, you can start on the micro sizes. Due to the size of the contract, this allows many more investors to be able to participate in this market in a way more suited to their profile. If you are a new investor, the first part of the seminar will serve as an introduction to explain the characteristics of index futures. For the second part, we'll discuss on how to use a spread market to roll over positions to maintain for the long term. Throughout the webinar, you may have questions. Feel free to post them in the question box. My facilitator will arrange them and let me know, and I'll answer them during the webinar or at the end at appropriate time. This webinar is also recorded and will be put out for viewing on YouTube to be viewed at your leisure time. So just sit back, relax, grab a drink, and enjoy the webinar. Before we start, this is the disclaimer. Basically, it says that materials provided here is for general information and does not constitute a recommendation for trade. All right, let's take a look at the agenda for today. The topics that we cover in this webinar is as follows. We have a general perspective of what the product is, as the CME Index Futures. How does Index Futures work in general? After which we'll take a deeper look into the characteristics of each of the individual index futures. Therefore, basically, but we'll touch on three. We'll be covering more on the popular S&P 500 and Dow Jones. After that, we'll move into the calculations of the trades. In other words, to find out how the profit and loss works. We'll then wrap up the first part with the reasons why we choose to trade microemini index futures compared to the other available similar products out there, such as CFDs and ETFs on indices. The second part of the webinar will be touching on calendar spread market. For investors who wish to continue to hold their position even when contracts are expiring, a rollover of the active month contract to the next month is required. This will be executed by closing the expiring month contract position and opening a new one. You can also do so with the spread market, which basically executes both trades simultaneously for you. Lastly, we'll touch on the demonstration of Phillip Nova trading platform when we have time, to let you have a feel of how the platform works and take a look at the calendar spread. Without further ado, let's get started. What are microemini index futures? The index futures is used to speculate the price direction of the index. The underlying is the stock index, like S&P 500, NASDAQ 100, Dow Jones. The two most popular are, of course, S&P 500 and Dow Jones. These indexes are basically tracking an underlying basket of shares which moves the index itself. So if you are interested in trading the stock market, but you wish to invest in a basket of shares, the E-mini index futures will be an appropriate tool for you to use. There is also the micro contract, a smaller size contract, which is relatively new, but it has been more than a year now, much scaled down from the predecessors, the E-mini index futures. This means the micro E-mini is 1/10 the size of the regular E-mini. This enables more retail clients to be able to enter the market due to the smaller contract size. The risk exposure is reduced and better managed. The index futures are traded on the US exchanges like CME and CBOT, meaning to say it is a fair open market where investors come to the central market to trade. The counterparty is not any single institution, but anyone ranging from financial institutions or retail investors all around the world. It is a huge market. Estimated average trading volume of 1 million micro contracts daily for micro E-mini S&P in October 2021. Below, you can see the ticker symbols for the mini index futures as well as the micro E-mini index futures. Basically, the micro has the letter M in front of the ticker symbol. For example, the S&P ticker symbol is MES. Okay, let's move on. How does trading micro index futures work? Take S&P for example. So let's say we want to trade and invest in the stock market. You can actually use this index futures to enter the market. Consider this as investing in the top 500 US companies, but you just need to buy one contract of the micro E-mini S&P. Currently, the initial margin for one micro contract of the E-mini S&P is $1,265 US. So take for example, S&P is trading at 4330 currently. You can enter the market to buy one lot of the micro S&P at 4330 points, which has a notional value of $21,650 US. You can then wait and sell at a higher price when the index rises. For example, if it rises to 4430 points, the notional value becomes 22150. This means that you would have made a profit of $500 from this trade without buying the actual shares. Hence, it is a pure speculation of the index by buying the index first and selling when it rises. This can also be done for the short side by selling the index first and buying it back when the index drops. But we will explain more for the short selling later on. So there's no interest or financing costs on the positions, unlike other products like CFDs, which have financing costs on the borrowed margin or leverage. As long as you come in with the funds of 1,265 US dollars for the micro contract, you can also substitute with the equivalent amount of Sing dollars if you prefer, which is roughly about 1,800 Singapore dollars now. But interest will be charged on this margin of 1,265 US dollars since you have the funds in Sing dollars. Alternatively, you can convert the Sing to US dollars to avoid interest charges completely. This is recommended for the long-term positions, but for short-term, it is a choice for you whether to reduce the number of rate conversions. If you have USD funds, you can actually come in with USD funds also, instead to avoid the interest charges. Other than that, there is no financial charges and you can hold a position as long as you want. However, you need to do a rollover every 3 months as the contract expires every 3 months. For the commission, it will be $1.50 USD on promotion now per site per trade. For the promotion will end on 30th of December this year. This means for a round trip, it will be about $3 US. Normally, it will be about $6 US. This is easy to break even, which means there's only 3 ticks to break even. So there's a lot of liquidity. The spread is tight at 1 tick, which is exactly 0.25 points. Next, we'll move on to look into the S&P 500 index. Standard & Poor's 500 index, or the S&P 500 index in short, is a most heavily traded contract amongst all the equity indices. In fact, the top most liquid futures contract trading. Understandably so, as it tracks the S&P 500 index, which is a market capitalization weighted index of the 500 largest US public traded companies. It can be regarded as the best gauge of large cap US equities. Companies include Microsoft, Apple, Amazon, Google, Berkshire Hathaway, etc. Due to its wide coverage of the US stock market, investors who wish to invest in a wide basket of US shares may consider trading the S&P Index Futures. Next up, popular US index, the Dow Jones Industrial Average. It measures the stock performance of 30 large companies listed on the stock exchange in the United States. Comparatively to S&P, many does not consider it to be an adequate representation of the overall US stock market. But the industrial portion of name is largely historical, as many of the modern 30 companies now have little or nothing to do with traditional heavy industry. Because it only includes 30 large companies, it is not weighted by market capitalization and does not use a weighted arithmetic mean. It is simply a price-weighted index. So even though it doesn't cover many companies, it's still a very popular choice among investors. The companies included are all listed here in the table below. Companies such as Apple, Boeing are inside as well. So one of the other popular ones is the NASDAQ 100 index. Alongside with Dow Jones Industrial Average and S&P 500, it is one of the 3 most followed indices in US stock market. Although it's NASDAQ 100, there's actually 102 listings due to some of the companies having more than 1 listing because of the size of the shares. The composition of the NASDAQ Composite is heavily weighted towards information technology companies, which is the IT sector. The NASDAQ 100, which components are a subset of NASDAQ Composite, accounts for over 90% of NASDAQ Composite's movement, and there are many ETFs tracking its performance. It includes the FANG stocks, which stands for 5 most popular and best performing American technology companies, namely the Facebook, Amazon, Apple, Netflix, and Alphabet, which is formerly known as Google. So, having gone through the introduction of the 3 indices, let's look at the contract specifications of each of the lot size that you're looking at. You can see the margin listed here that's required for each of the micro index futures on the left of each table. For microemini S&P and micro Dow Jones, the margin is 1,265 for E-mini S&P and about $990 US for the microemini Dow Jones. This means if you just want about $1,000 to $1,300 or equivalent amount in Sing dollars if you prefer, you can enter to buy or sell one lot. Let's say if you look at E-mini S&P, the smallest tick movement is 0.25, which is equals to $1.25. So per tick, it would jump 0.25, and that would equate to cash money of $1.25. Since the commission for the round trip is $3.21 USD for a round trip, that would mean that 2 ticks or 3 ticks will break even with a profit. The contract value is shown here at $5 times index. So what it means is basically you get the index times 5 is the total value of the contract. The index now, let's say, is at 4,500 for the E-mini S&P. Multiply that by 5 will give you a value of about $22,500 US. So you can see here that you only come out with a fraction of the value of this contract value at only $1,265 US, which is the leverage of 17 times. For the mini size, everything is just 10 times of the micro size. For beginners, you can try out the micro size first to get used to it. You can also do multiples of this micro size contract if you find the movement too slow. Once you get used to it, you can actually upsize to it to the E-mini regular size. Therefore, you can do 2 or 3 micros and multiply the effect for each movement, and when you're ready, change it to the E-mini regular size. Do take note that this applies if the market goes against you as well. The same principle applies to other contracts like microemini Dow Jones. As you can see, this per tick movement is 1 point is 1, which is equals to 50 cents US dollars. So NASDAQ is shown below. So the smallest tick is 0.25, and for the microemini NASDAQ is 50 cents US dollars. So feel free to come back to this tables, this slide again when you're free. You want to find out more on the contract specifications. The contract specification, part of it can also be shown on the Nova platform. I will show it to you later. Okay, having a look at the contract specifications already, let's now move on to understand what the characteristics of the index futures are. The index futures is a bidirectional market, meaning you can buy for the upside, and also you can sell first if you think the market is coming down. Then after it comes down, you can buy back at a lower price to take profit. This allows you to short the market, unlike straight stock buys, which does not allow short selling. As shown, there are 2 contract sizes you can opt for. The micro size for controlled sizing, and the bigger mini size, which is 10 times bigger. You can do denominations of each contract as well, like mentioned before. The initial margin required is about 6% of the contract value. You do not need to come up with the full value of the contract. This is actually a leverage of only about 17 times. As mentioned, the margin at this moment for micro Dow Jones is $990 US, and for the micro E-mini S&P is $1,265 US. You can fund with USD or SGD to enter the contract, but interest will be charged on the borrowed USD margin. For short-term trades, it is advisable not to convert the Sing to USD to avoid exposure to currency rate changes. Since it's on leverage, there is a mark-to-market every day at Singapore time 5 AM. However, coming November 7th, the daylight savings will sit in and this will change to 6 AM. This is based on the daily settlement price provided by the exchange. Based on this, if the position is in the money or making profits, you can still manage the position. However, if the market goes against you, you need to top up the difference to hold the position. This is known as the margin call. I'll explain in detail in the next slide on margin call. Next, the expiry is once every 3 months. So this means that the available months for trading are March, June, September, and December. When it comes close to the expiry, you need to close out the position to realize a profit or loss, or simply roll over to the next month to maintain the position. you only incur the common charges for this rollover. There will be no financing costs or interest for the leverage. We just need to have sufficient margin, which is required in USD or SGD equivalent. For long-term positions, you can convert to avoid the interest charges. All right, that's basically the quick glimpse of the characteristics of index futures. I hope you are following so far. We'll now move on to the actual calculations of the individual trades. So shown here is the example on microemini S&P, and this is the December contract. The bid and ask price is shown here. As you can see, 4,334.75 versus 4,335 even. This is a spread difference, the spread of difference of between bid and ask of 0.25, which is the smallest tick. So one contract size is one lot, and the initial margin, as mentioned before, is $1,265, which is 17 times leverage. As long as you have this amount of funds in the account, you can start one position as one lot in the micro mini S&P. So the smallest tick here, to repeat, is 0.25 equals to US $1.25. So 1 point movement in the index will mean that this is actually $5. By simply multiplying by 4, you get 1 point, and that will equate to $5 USD. So let's assume we have $1,265 in the account. And we've decided to short the market, means to sell the market in view that the market will go down. So let's sell one lot of the microemini S&P at the market price shown here. We look at the bid price, which is 4,334.75, which is our entry price to sell one lot. And subsequently, assuming that the price drops down to the price level of 4,304.75, this will be we'll do a buyback at this price, and the difference between the selling and buying price is about 30 points in the movement of the index. So as we mentioned before, 1 point is equals to US $5. 30 points movement will actually equals to 150 US dollars. So in your account right now, from 1,265, you add on 150 US dollars minus the commission, the 6 US dollars, which is with that promotional rate, you will get 1,409 US dollars in the account. This is a simple example of a profitable trade where you sell the market and buy back at a lower price to capitalize on the bearish market. Let's now look at another example where we do not close out the position but leave the position open. So looking at the CME Mini S&P again, also the micro lot size, the initial margin is also one lot size, and the initial margin is also 1,265 US dollars, and there's no change in the tick as well. 0.25 equals to US $1.25, and 1 point equals to US $5. However, this time the only thing that changes is the amount of funds in the account. We have 1,500 US dollars, more than enough of the initial margin requirement, 1,265. So let's sell one lot again at micro mini S&P market at the same price, 4,334.75. Right. This time, however, we do not close out the position at all, and the market closes and settles at the price 4,300, which is the closing price, called the settlement price, as the exchange releases this settlement price. So there's a difference of 34.75 points, and by doing a simple math, multiplying by 5, you get 173.75 US dollars. This is actually unrealized profit. This is unrealized because you have not actually closed out the position, but just based on the settlement price, which is mark to market. So in your account, you have 1,500 plus 173.75 unrealized profit, giving you 1,673.75 US dollars. So this could change the next day or the next hour if the market goes against you, until you actually exit the position at the executed price that you have. Okay, so following so far, we are using the short position to illustrate the example of entering the market. Next, we'll move on to a losing trade. So over here, looking again at E-mini S&P Micro, and The amount of funds in the account is also 1,500 US dollars. Now we also entered to sell one lot at 4334.75. However, this time the market goes against us and the position is being caught. The settlement price is now settled at 4,400 points. So as you can see, there is a difference of 65.25 points, and this is a negative difference because you have actually sold the contract instead of buying, and the index has actually risen to 4,400. So you're sitting on a paper loss of 65.25 points of the index, which is equals to $326.25 US dollars. So let's do a calculation whether our account is positive or not. Since we have $1,500 in the account, minus off the unrealized loss based on the settlement price of 326.25 US dollars, we'll get ourselves 1,173.75 US dollars. However, we mentioned that the initial margin required is 1,265 US dollars, which has to be maintained at all times. So since we have not sufficient funds to meet this requirement, we need to do a top up. And the amount of top up required is this initial margin 1,265 minus off what we have in the account 1,173.75, which is a $91.25 USD top up. So you have up to 2 days to do this top up. Else, if you do not top up on T+2, you have to be liquidated at the market close on T+2. So for example, let's say today is Thursday, right? You enter the position, and at the end of the day, you have this margin call shown here. Tomorrow is T+1. You have one more day, T+2, which is the next Monday, for you to do the top up. So if you don't do the top up, they will just liquidate position at the end of T+2 next Monday at market close. So this is the example for the stop loss, the margin call. So I hope you can follow it. We'll take a quick break. On the next slide, we'll go on to why we trade microemini index futures. Right, let's continue. So why do we trade the micro index futures? Well, first up, in summary, the advantage of trading micro index futures is the control over risk exposure. Since the micro size is 1/10 the mini size, it gives investors control over the contract size they wish to enter. This allows more retail clients to participate in the market. With the electronic trading online, it is a highly liquid market, which is excellent for intraday trading. This means you can enter and exit the market quickly when it's volatile for a quick trade. There is no financing cost or leverage. So you can hold the position without worrying for the interest charge, as compared to CFD where there is financing cost. Only thing is the margin which can be charged interest. This can be totally avoided by coming in or converting the funds to US dollars. There's no counterparty risk, and done trades are confirmed, as it is executed on a transparent exchange. With the high liquidity, the bid-offer spread is tight. This makes it easier to break even with a tight spread. The round-trip commission is small at $3 US, as compared to 0.28% on the stocks. This is a promotional rate which is likely extended to December. The usual is $6 US. With round-the-clock trading from Mondays to Fridays, 6 a.m. to 5 a.m. Singapore time. Coming November 7, it'll be end of the daylight savings, so it'll be 6 a.m. instead of 5 a.m. closing. You can trade on the go or at night at home, and close the trade anytime you wish. The weekends, however, the exchanges are closed. Compared to other products like the ETFs, which is only available in the day, CME Index Futures give you the opportunity to trade in the night, in the evening when you come back from work. So this is a summary of why we trade micro index futures as compared to CFDs and ETFs. Right, we come to the next portion of the webinar, which is the calendar spread. Calendar spread is based on the same underlying, meaning that if you are doing E-mini S&P, your spread will be also on an E-mini S&P contract of a different month rather than the same month. So it can't be E-mini S&P and then another one with E-mini Dow Jones. So calendar spread has to occur on the same underlying contract, just different months. It is a price difference between two calendar months contract, which involves buying a contract and selling another. Notice here there's two actions here, one buy and one sell, and it cannot be two actions the same. For example, let's buy the front month and sell the far away month. The front month meaning the closer month to current month. So right now the index futures, probably you are trading at, now it's October, you are trading a December contract, and the far month will be March contract of next year. So as I mentioned, these are opposite directions as a buy and a sell. Having the same direction would just be a normal outright trade and would not be considered a spread trade. Of course, there are strategies on trading the spread, widening or closing, but today's topic will solely be on using the spread market for the rollover of open positions that you have. This would mean you already have an open position ready, be it is a buy or a sell direction. As mentioned, futures contracts have an expiry date. For all the CME Index Futures, micro or E-mini, this will be the third Friday of the traded month. I will show you later on the Nova platform where you can find this last trading day info. When this day arrives, you can close out the position, or if you wish to maintain the position, you need to do a rollover of position to the next available month. This is not automatic. You have to do it yourself. If you do not do anything, the exchange will cash settle the contract based on the settlement price released by the exchange. Basically, close out your position. To do the rollover, simply just close out your position first for the expiring contract month, and then open a new one in the next month. As your aim is just to avoid too big a price difference between these two contract months, it is advisable to do it during quiet trading hours such as Asian hours to avoid volatility in the market. Alternatively, we have the spread market, which executes both sides of the trades for the 2 months for you at the same time. Both methods, whichever you choose, can be done on the Nova trading platform, which I'll show you later. Next, the rolling over of positions. Let's take a look at the example in specifically the E-mini S&P December position. So the prerequisite is that you need an open position. Right here we have a long position in the E-mini S&P December. The last day of rollover for this contract is 23rd of December, which is 1 day before the third Friday. It is advisable not to wait till the last day to do the rollover due to the diminishing liquidity, which will mean will be a wider spread. To roll over means you have to close out the December contract which you already own, which is sell the December contract, and then buy the March contract. As shown here, sell December, buy March. CME Index Futures are quarterly month contracts, so the next available month is March contract. As you can see here at the bottom is the table for the 2 contract months, the December and March 2022. To sell at the market price, we look at the bid price on the December month contract as highlighted in the red box. To buy, we look at the offer price or the ask price on a March contract, also in the red box. So for the December month, the selling price is 4367.5. And for the March contract, we buy at market 4360.5. As you can see here, these 2 months do not have the same index price, right? There's a spread of 7 points. So you sell, to repeat, you sell 4367.5 December, and then you buy 4360.5 in March. This will allow you to roll over from the December month to the March at a spread difference of 7. In this case, the price in March is lower, so it's better for you. Next, we'll look at the rollover position of the spread market again with the calendar spread. Using the same example with the long position in E-mini S&P December to roll over to March contract, shown here is the spread contract below the 2 individual months. So you can see the pink color contract here is the additional contract, spread market contract. For this case, since you're long, you need to execute a buy on the spread to roll over. I'll discuss on how to determine to buy or sell on the next slide. But first, notice that the spread shows the calendar spread in bracket CAL, CME Mini S&P S for spread December 21, March 22. The 2 months are shown here for the spread, which is December 21 and March 22. So you are looking to buy at the offer price if you are in long position, which is at minus 7.5 spread. This is actually better than what you have in the previous slide, which is minus 7.0. Since buying price will be relatively lower to the selling price, you can queue for even a wider spread by queuing it as a limit order for minus 7.5 and above. If the spread widens, it will execute both trades at the same time. It will sell the December contract and buy the March contract for you. Please note that you'll not be able to determine the actual price which it will buy for you or sell for you, but it will be simply the price difference that you are determining for the buying and selling price. So how do you determine whether to buy or sell the calendar based on your position? Let's look at the E-mini NASDAQ now. Pulling out the contract, calendar spread for December and March for E-mini NASDAQ. The far month, which is a further away month, is the lead month. So always remember, when you're looking at the calendar spread, you look at the far month is the lead month, which you will make a decision whether to buy or sell. So currently, since you're long or you're long the position in the December month and you want to maintain this position in March as well, you need to buy the March contract. It's the same position direction as you initially had, which is a long position. So to make it easier, I repeat, to remember, you always look at end of the contract name to see which is the lead month. Please note that this only applies for index futures spread and it's not for commodity spread, which will be different. Vice versa, if you have a sell position instead in the December contract and you need to roll over the sell position to March, you have to sell the December March contract instead. So you need to look at the bid price here. Right, so in short, look at the end of the contract name, and that will be the lead month, and will decide your decision of the direction from there. So we have covered on the examples of the spread market. So things to take note for the spread market. 1, you need to have an open position to roll over. So in the examples, we always have either a long position or a short position, and we want to maintain this position. So example, in the previous examples are the December contract, we have long positions. Else you end up with 2 open positions in 2 contracts. So spread only focus on the price difference, not actual price. So if the price difference is wide or narrow, hence you can't decide on exit price of your open position, but only on the price difference. Margin will be required for the queuing of this spread order. This will be 50% of the margin For example, let's say you have a position in the microemini NASDAQ which requires 1,265 US dollars. To roll over using the spread contract, you have to have additional funds of 633 US dollars in order to place the trade. But not to worry, once the order is done, this margin will be released back to your account. However, you need the extra funds to do the rollover. Once the spread order is done, that means you execute two trades, the sell and the buy of the new position. It will be reflected immediately in the trading platform, and you will also show the individual trades of the buy and sell order, so you know what are the prices they have been executed at. So that's the summary of the spread market. Hope you actually have followed so far. So all the futures index futures, as well as all the other commodities, are all traded on the Phillip Nova trading platform. This platform can be accessed via the PC desktop or on your mobile as well. We'll move on to show the demonstration of the platform right now. Right over here, we can see the demo platform for the Nova. Well, if you are interested to sign up to take a look, feel free to look at the last slide later on and key in your details. So, shown here, because this is demo, we do not have the US indices. We are using another index futures, which is China A50 contract on the SGX. So since today is the expiring date for SGX A50 already of October, let's remove the contract first. So by editing, we can click on the cross button, and then we also remove the spread from that. We'll add on the contract from November to December. So let's add on the futures contract for China A50 and select the December month. Also, we need to add the spread market. So let's go to spread, to go to the spread market and look for the contract itself. So over here, for example purposes only, we are using the China A50. And we have to look for the one that we want to roll over, as our months are November and December. So this is a monthly contract, unlike the US index futures, which are quarterly. So we have to look for the November-December contract. Starting from here, the November-December contract, that's right. And has been added to the watch list. So from here, you can see the prices for the individual contract month, November and December. And this is calendar spread. Right. So let's start with an example of a position in December. So let's execute the buy trade. Just click on the, let's do it on the November contract so we can roll over. We place the order, and then we want to do a market order to execute. Let's say we have a short position to sell, right? So we sell the position at the market price of 15826. Click sell. Right? Do you want to sell? Yes, one lot. So once you have sold, right, you're in position at 15826. Right. So let's assume at the end of the month, right, this contract is going to expire and you need to do a rollover. So what does it mean? It means you have to close off this position to buy back at market for the buy back the China A50 for the November contract, and then to sell at the December contract. So you buy at this price at 15827, and then you sell at the December contract, which is 15803. So over here, the spread difference between these two prices, 15803 and 15827, is 24 pips, 4-point spread, right? So similarly, over here, you have the calendar spread, which you can execute it separately instead of individual contracts by selling here, buying here and selling here. So we just can click on the sell for this one and the place for the trade for the calendar spread. So you can see that the spread here is 14 points instead of 24, which is a tighter spread, right? On top of that, you can also queue for a lower price instead. So let's look at market depth. So the current price, we have a sell for 15 right now, 11 right now. Sorry, minus 14 right now over here. So there's a ready market for you to sell at a 14 spread difference. If you want a wider spread, you can go for a Q here, a limit order over here, right? So to do so, we can't place, because of the demo account, we can't place a trade. But this is basically how you place the trade. You can place order, you bring out the trade menu, right? And then you can actually place the order for the spread market. As you can see, the contract is November, December to roll over, right? So if you want to go for a wider spread, you can do so. Let's say very far wider spread minus 20. You can do so, right? And then you click on the sell button. I will try to do that, but I can't execute because of the demo account, right? So instead of using the spread market, you can close out individually by closing out this contract during a quiet Asian hours and then opening the contract again. So let's maintain this version. So let's close out first, sell this November contract month by clicking on this. Actually, we have already opened the contract already. So we'll buy at market over here to close contract. Yes, November contract is closed, so we do not have any position. And then we continue immediately to execute a sell trade on the December contract months. So take note to double check the contract month before you execute any trade. So this is a December contract month. So we want to sell at market also, and we do so at market. Sorry. Yeah. So in this case, we have brought over the position from November to December, just like that. All right. So as you can see, you can use the spread market to queue for the spread that you want, or you can do the individual close up. Right. Next, we'll look at the contract specifications that's available. Simply on clicking on the contract itself, and then on the contract specification, you'll be able to see the last trading day for expiry. So for this month, is a monthly contract. The December month will expire. Sorry, this is a calendar spread. Let's click on this November contract here. Contract spec for November will expire on the second last business day, which is 29th of November. So coming 29th November, you need to do a rollover before that day. Not advisable to leave till the last day, but you can do so one day before, right? So information on when is the contract expiry can be found here. But due to time constraints, we will not be covering the charts and other things, but there's also a chart available over here. You can simply look at charts, and then you'll be able to see the chart for the contract itself. Okay, so use the November contract. You'll be able to see the continuous chart for it, right? So feel free to sign up for the demo account if you want to, to find out how to execute some trades on the index futures. However, we do not have the US index futures due to the data availability for the charges yet. So you can only try out on other contract sites, but feel free to sign up for the demo account if you wish to do so. Okay, we have almost come to the end of our webinar. I hope you have found the info useful. Let me just touch on the available services offered by Phillip Capital. You will sign up for the account, which is available online using my QR code that will be shown later. I'll be providing WhatsApp economic data updates every week. There will also be technical discussions on trades, and I'll be assisting you with any questions pertaining to your account or trading. I cover markets on Forex, global indices, precious metals, energy, and commodities. You'll still be executing the trades yourself, but you will have a second perspective on the technical aspect of the trades. On top of that, we have the Trading Central research portal. Like the example shown here, our in-house analysts will email the technical reports on suggested levels on the S&P 500 Dow Jones for your reference. This will be on the suggested entry and exit levels for your consideration. It will be sent daily as daily trading highlights showing the directional views from the global research desk of Trading Central. These are good starting points for you without having to do research yourself to identify opportunities that will make sense. Pairs will include stock indices and commodities, namely S&P 500, Dow Jones, Nikkei Index, China A50, and crude oil. Daily commentaries will also be sent out for fundamentals. We have covered with commentary reports to give you updates on the economic news happening around the world. This will keep you updated on the latest economic news that might have potential impact on the markets. This will save you a lot of work searching for it on the internet. Hence, we provide the fundamental as well as the technical aspects of trading information to you, and you can have a platform ready to enter the market when you are. So besides the analyst reports, you can also reach out to me on technical views on the trades. Next, we have the promotion that's ongoing, as I mentioned, for $1.50 per micro lot size. When you place a trade as small as 1 micro lot size, it's only $1.50 right now and until the end of December this year. So the products are available shown in the table. To be eligible, however, you need to sign up for it. The link I'll pass to you if you are in, when you open the account, or if you are an existing user, feel free to let me know. I'll pass you the link to sign up for it. Feel free to take this opportunity to open an account to get familiar with the micro sizes, since there's a promotion of this trading going on. To open an account, trading in index futures with Nova is actually very easy on the desktop. There's also a mobile app to trade on the go for your phone. So if you're interested to get started, you can open a live trading account with Phillip Futures at no cost at all. There's no maintenance fee or other charges. The entry level is low, as you can start trading with margins as low as $1,000 US to $1,500 US with a micro lot size in the index futures. So if you have been thinking of opening an account to get ready, maybe to trade indices when the market corrects itself, or even if you have a view for the upside, but you need a way to enter and exit the market quickly, this is a good time to start with this low comp rates of $1.50 US. You can get started with the account first and then trade live when you are ready. But you can view the live price on the platform and you can monitor them. So you can also do paper trading on the demo account if you're interested. However, the US indices will not be reflected there. So as I mentioned, there's no admin fee or any cost in maintaining this account, and you can simply just open it for free and view the live prices. The process is very easy, simply by SingPass login, and this can be completed within minutes. Simply create an ID by scanning the QR code shown here. The link will be tagged to me, so I'll be assisting you if you open the account using the QR code. Alternatively, you can use the URL as shown here to access the account opening online. Foreigners can also open an account online by the QR code. If you have further inquiries, please feel free to drop me a WhatsApp message or email. My contact information will be given at the next slide soon. So this is almost the end already. We'll just touch on the Q&A first, and then we'll wrap it up from here. So I have a question. When we roll over the contract because of expiry, would there be commission charge? Yes, there's a commission charge. So just the $1.50 for the promotion rate, and then for opening a new contract, that will be another $1.50. So in total, that'll be $3. Normally, it's $6 US for the round trip or the rollover for one lot size of a micro. So if you have multiple contract size, you have to multiply accordingly. So 2 contract size, you have to multiply by 2. How much is the interest charge if we use Sing dollars and not converted to US dollars? Okay, this is a initial margin required of $1,265 US for the EME S&P micro contract and $990 US for the micro NASDAQ, the micro Dow Jones contract. So if you do not convert to US dollars of this amount, if we charge on this amount of US dollars, about $1,000 worth of US funds, which is not very high, and the interest rate is roughly about 7% per annum, and it's calculated on a daily basis. So the interest rate is 7% calculated daily on the initial margin required. So we have the next question. Does the platform also available via phone? Is your demo account chargeable? Right. The platform is available via phones. We have a app for it, which you can download. So it's very user friendly, and you can also trade on the go using this app, which is the same display, almost the same functions as you see over here on the desktop itself. So it's not chargeable at all. So just feel free to sign up for the demo account to log in to see the live prices. However, as I mentioned, US prices are not available due to cost, and but they are available when you open the account for free. So why not sign up for a live account and view the US prices for free, right? Is your coaching services free? Yes, they are free. And if you have any questions, you can accumulate them and let me know. And once you open the live account, we can arrange a session via Zoom, and I'll go through the coaching with you on how to on the technical aspects of the things for the analysis of the charts on the indices itself. So this is usually done over Zoom one-to-one. So at the time of convenience, if you're interested and you've signed up account, we can actually arrange a session for this one-to-one free coaching session. So one more question. Can I clarify microemini S&P is unavailable on Nova? That's why you didn't do the demo. Let's see what it means. Yeah, as I mentioned, because the US live price access, there's a fee charged to it. That's why we do not release the live price feed to you on the demo account. So we are not able to do the demonstration for you on the demo account. So, but you can actually see from a similar aspect of it using the Singapore contracts, which is basically the same method of the rollover. So the point of the demonstration is just to show you how to do the rollover for open positions that you have and when your contract is expiring. So there's totally no difference between doing it on a contract of SGX or the CME contract. It's the same procedure. Okay. So we have come to the end already. Yeah, thanks for joining us. So as I mentioned, the entry level is low, and you're interested to sign up for the free live account, feel free to do so. And when you have done that, I'll be able to arrange a coaching session with you via Zoom at a time which is convenient to you. And in that coaching, I will just touch on the technical aspect of the analysis, right? So that's all the time we have for today. Feel free to drop me a message or email me if you have further queries. So thank you so much for being such a wonderful audience for tonight's webinar. A link will be forwarded to you shortly, actually tomorrow, in our follow-up email tomorrow. So if you have any query on the webinar or would like to get started, just reply to our email. Or if you want to sign up demo account, you can scan the link over here as well. Right, so we have come to the end already. This is Phil Gunn. I'm signing off right now. So have a good evening ahead. Thank you very much. Sorry about that. The contact details are shown here. Yeah, if you want to get in touch with me, feel free to scan the QR code over here for coaching, or drop me a message or email me on my contacts here. Thank you.